Welcome, and thanks for joining us today. My name is Kara Bloomberg. I'm the Chief Operating Officer of Landrum HR, the parent company of HRQ. Many of our clients are on today. Welcome. We appreciate your partnership and your attendance. And for those of you that aren't clients and aren't familiar with Landrum HR, HRQ, we are a professional services firm. We've been around for 50 years serving clients across the country. We provide 4 primary service lines of business. PEO includes payroll, benefits, workers' comp, and HR. We also provide worksite management, which is a customized labor solution for companies that use large numbers of temporary workers. Our HRQ division provides 3 integrated services: enterprise-wide human capital consulting, which you'll see today, providing interim HR talent, and conducting searches for HR professionals. Our consulting team, led by Brian Wilkerson, has a deep understanding and experience in workforce planning and analytics, talent management and talent strategy projects, org design, and HR transformation needs. You can find out more about all of our services by visiting our websites, landrumhr.com and hrqinc.com. A recording of this webinar will be sent to everyone who registered today. Please feel free to ask questions using the question pane in the control panel, and Brian and I will try to get to some questions at the end of this presentation. The handout includes our slides from today in the handout pane. There's a quick survey that's going to pop up as you exit the webinar today, and we'd love to get your feedback, hear more about topics that you're interested in so we can bring those to you in future webinars. So I'll introduce Brian Wilkerson, and it's my pleasure. He's held senior leadership roles in both large enterprises and global consulting firms. He's a successful entrepreneur, having founded and led a consulting and software company that was sold in 2007. A deep specialist in driving innovative strategies and using cutting-edge planning techniques, and he's worked around the globe. Brian is a frequent invited speaker and is thought by the press for his insight. He's authored a number of articles and book chapters. Brian, I'll hand it over to you.
Great, thanks, Kara, and welcome everyone to our quarterly economic update. Today's an interesting one. I'm going to talk a lot about Q3 and what happened in Q3 because that's where we have final numbers, but some of you may have seen preliminary numbers for Q4 that were released this morning, and I will talk a little bit about some of those numbers because it really illustrates the kinds of interesting trends that we've been experiencing over the course of the past year. So to start off with, at the highest level, the overall in Q3, the GDP increased by about 33.4%, which looks great, right? It's a big improvement from Q2 where we dropped almost the same amount, but looking at Q3 activity, we were still about 658 billion below the high of Q4 2019. So still, some challenges from a recovery perspective. But the bad news is that if you've seen the numbers for Q4, or the preliminary numbers, I should say, for Q4, the GDP growth for that quarter is only projected to be about 4%. And it's looking like we will net end the year with an overall decline of about 3.5% in terms of overall GDP. And this is really symbolic of what we've been seeing throughout the course of the pandemic, with numbers swinging fairly wildly and economic activity varying quite a bit as we look at things. And so it's been challenging in many cases to help get a handle on what the right strategies are based on that, but we'll try to provide some clarity and try to give folks some guidance. So overall, great increases in Q3, but certainly a significant slowdown in Q4. For as you know, a number of places went under further restrictions as post Thanksgiving and lockdowns started to happen again after we saw surges in the coronavirus. So while the data is not surprising, it is certainly a bit concerning in terms of the level of slowdown that we've seen. When you look at the overall breakdown in terms of the components of GDP, when the numbers haven't changed a ton in terms of the mix 70% of the activities is still driven by consumers. And while we saw some improvements in consumer spending from a standpoint of Q3, the preliminary numbers for Q4 show that growth has dropped all the way down to 2.5%, which is pretty anemic in terms of overall spending on the consumer side. So again, as people started to look more conservatively at the economy, more restrictions were put in place, et cetera. We saw a pretty significant slowdown in consumer spending in Q4, and we'll get those final numbers next month. From a business investment perspective, we saw some spending increases in terms of business investment, both especially in the residential area, but some in the non-residential area as well. From an overall federal or government perspective, spending was down about 4.8%. The federal government backed off its spending quite a bit from some of its earlier stimulus packages and different legislation that really stimulated the economy. State and local was down about 3.9%. Overall net exports stayed pretty much the same. We still run about a -5% net export deficit, so not much change in those numbers. But when you look at all of these different components, what it shows is that while we did see some rebound, we did see some improvement in certain areas, we're still kind of in a place where heavily dependent on consumer spending, and that can vary and that can swing quite a bit as we look at things. Looking at the labor force itself, there's a number of numbers here, so I'll take a few minutes to go through this. When you look at the overall labor force, from December 2019 to December of 2020, the size of the overall labor force, which is really looked at as the population above 16, increased by almost 900,000 people. But at the same time, the actual folks that are participating in the labor force went down quite a bit. We lost over 4 million workers participating in the labor force, but in that same time period, December 19 to December 2020, about 2.4% of the overall labor force, and the labor force participation rate went by about the same amount. Now, that is a bit of an improvement from where we started in terms of where we ended up with the year. We had a lot of losses in the labor force, so we start to see some improvement in terms of labor force participation, but we continue to see overall weakness in that respect. From an unemployment rate perspective, we were at 3.5% in December of 2019. We are looking at a December 2020 rate of 6.7%, so nearly a doubling of the overall unemployment rate. Similarly, when you look at the December 19 numbers to the December 2020 numbers for the U6 unemployment rate, which also looks at discouraged workers, folks who are working part-time that would like to be full-time, et cetera, we saw an increase there as well of about 5%. Now, the good news is if you look at the middle column is sort of the low points were up from those low points. The total unemployment rate was as low as 14 or as high as 14.8%, and the U6 unemployment rate was as high as 22.8%. So we have seen some improvement off of those low numbers. We've improved quite a bit, but still not even back to where we were in December of 2019. So overall, when we look at the labor force, you would still have to say that there's a lot of weakness in terms of the job market and unemployment. When you start to break that down by gender, you see a number of trends that are concerning as well. You can continue to see that women are unemployed at a higher rate than their overall composition of the workforce. It's narrowed a little bit in terms of where it was from December 2019 to December 2020, but you still see a little bit higher of a percentage there. And many of the issues that are cited in terms of women leaving the workforce are around, access to childcare and increasing expense around childcare, and schools being back in session, and that causing a lot of challenges in terms of hybrid learning models, at-home learning models, and the support required to really make those happen. So we continue to see some concerns about unemployment by gender. Similarly, by race, when you look at the information as the Department of Labor breaks it down, for African Americans and for what they classify as other by race, and for Latino versus non-Latino, you see a disproportionate number of folks unemployed as compared to their total composition in the workforce. So from a social justice, social equity perspective, we still have some concerns in terms of looking at how unemployment is impacting the labor force and what we're seeing in terms of those numbers. Certainly, as you've heard recently from the new administration, there seems to be a strong focus on trying to address some of those things. But right now, the numbers continue to show some concerns and continue to show some weaknesses in those areas. When you look at some of the unemployment rates, as you break some of these down, unemployment rates right now are highest for African American men and for Latino women. Right now, as I mentioned, about 4 million people dropped out of the civilian labor force in 2020, and I talked a little bit about how those broke out proportionally. You can also see the chart on the bottom right that breaks it out by percentages, so you can see the change in the workforce by the demographics as the Bureau of Labor categorizes them. So 54% of the folks who have dropped out of the workforce have been women. 5% of the Black women in the labor force in December 19 have left, 3.1% of Latino women. When you look at that as compared to white women were about 2.6%, and Latino men are the least likely to have left the labor force. They've only had a change of about 0.3% as you look at the breakdowns. So a lot of information, a lot of things to digest in there. We're continuing to see a lot of that, and some of the other trends that I'll talk about a little bit further down the line in this presentation will also sort of highlight and punctuate some of these as well. As you look at the folks leaving the workforce, there's concerns beyond just sort of the initial economic impacts of folks leaving the workforce. When you look at some of the data that's coming out about career velocity and things like that, there's a lot of concern about people's careers essentially stalling because of the time that they have to leave the workforce, or where they have no choice but to leave the workforce. And what are the implications of that going to be as people return to the workforce on their career, on advancement opportunities, things of that nature. So those are things that we'll have to look at and continue to monitor as we look at some of these data. There's also a more significant concern that is beginning to emerge around people who are essentially tied to one income in their household, and that dependence on that one income has become greater. And as you see, when we get into causes of job losses and things like that, it puts a lot more families at risk in terms of losing, one of the remaining income in the household, and what that'll do from an overall economic impact perspective. So a lot of concerns to be had in terms of some of this data. When you break it down by industry, the red industries are the ones where there have been job losses, and the black letter industries are ones where there have been job gains. So when you look at a lot of the sort of goods producing areas, you've seen a lot of job losses in places like mining, non-residential or commercial construction, and manufacturing. From a retail trade perspective, some of the things like food and general merchandise have done well, but things like clothing, car dealers, and what you would consider more discretionary kinds of goods, sporting, hobby, music, things like that, have all seen some weakness or some softness. Education and healthcare have lost jobs. Leisure and hospitality have lost jobs. Air and transit, from a transportation and warehousing perspective, have lost jobs. Not really surprising considering the significant drops in volumes from an overall travel perspective. But the sectors, couriers and warehousing, home delivery, food delivery, things like that, have actually gained jobs when you look at it. When you look at professional and business services, those have also lost jobs in the time period that we're looking at, which is basically that December 2019 to December 2020 period. Net, from a government perspective, all branches, federal, state, local, have lost jobs from a net perspective. About 1.3 million jobs, or about 5.6% of the total government employment. So while obviously there's been a lot of money put into trying to protect jobs and stimulate jobs and things like that, we're still seeing a lot of challenges, a lot of losses in a lot of different industries, and very few who are actually starting, who have seen job gains. Interesting note on the residential construction area, a lot of preliminary indicators are starting to show a slowdown in that area as well. Some of you may have noticed, if you've tried to look at refinancing or purchasing a home, that mortgage rates have started to go up, and there's a lot of concern about where that market is going to go as well, and will that add to the weaknesses that we're seeing from a job market overall. So lots to be concerned about when you look at it. I mean, a number of industries have taken pretty significant hits in terms of overall number of job losses. When you look at the job comeback, and sort of this is more from an overall non-farm employment perspective, you can see that we hit lows at one point in terms of the big red line that you see here in terms of April of last year from a job perspective. But as you can see, the changes in employment have been getting smaller as we go through the year. So we've been gaining less jobs, and we actually lost some in December from a net perspective. And so, we were starting to see some improvement in those. That improvement started to decline, and now we're back to losing jobs. So in from September to December, we lost about 1.4 million jobs, a total decline of 140,000 in December, and that was really small losses in a number of different sectors, but the biggest ones were non-residential construction, manufacturing for non-durable goods, information, and banking. So those were the ones that comprised the most of that $140,000 loss in December. I'll pause for a second, because the picture that's really starting to emerge is that, when we had initial stimulus activity and a lot of focus on shoring up the economy, we did start to see some gains. We did start to see some things come back. As those started to expire or sort of play out in terms of their impact, and as we got later in the year, and then as additional restrictions started to get put back in place, we started to see losses in jobs, slowdown in overall economic growth, et cetera. And so a lot of economists are questioning now what the forecast for 2021 is really going to look like, and what are we stepping into in terms of, next year, and what the impacts of those things are going to be, absent some kind of concentrated policy responses. So far, what we've seen is, policies are heavily focused on, coronavirus vaccines and trying to, deal with things from a public health perspective. It remains to be seen what's going to be done from an economic perspective in terms of both Congress as well as the White House, and what impacts that might have. But certainly the needs continue to look urgent, because we are starting to see a significant slowdown and significant concern, both from a job and an overall economic activity perspective. I wanted to kind of pause and make that, because, lots of information, lots of things to digest. And so I wanted to talk a little bit more about kind of what does that mean overall. To give you a little bit more of a perspective on the job market itself, this chart actually shows why people were losing their jobs. And so black is basically folks that have quit. Green is layoffs or discharges, and blue are other reasons for leaving the job, which could be medical. There could be a number of things that fit into that. But when you look at the data, and we only have this data through November, we saw, in March and April, significant numbers of layoffs and other types of discharges as the big driving force. But one of the things that you're also seeing that's interesting as you start to get into June and later is that the percentage of people who are actually quitting their jobs is getting higher. We don't have good data as of yet as to what exactly is driving that. We have heard, anecdotally from a number of companies that as people are finding other opportunities, they may have been dissatisfied with changes that their company made in the workplace or things of that nature. They're starting to take those opportunities and actually pursue those. So that's causing some concern among a number of employers in terms of, are we headed for, a wave of people leaving or changing jobs if those opportunities do start to rebound and do start to come back. So a lot of organizations are trying to get a pulse of where their employees are now, to try to understand, how are they feeling about the things that were done throughout the course of the pandemic? How are they feeling about where the company is now, et cetera? This actually ties into some interesting data that we're starting to see about preferences in terms of return to work. We're hearing anecdotally from a number of companies that even when they're opening up the opportunity for workers to come back and to return to the office, many of them aren't taking advantage of it, and a lot of folks are having a hard time getting people to come in. Some recent surveys a couple of months ago that were done by the Center for Digital Futures basically said that 57% of the workers that they surveyed said that given their preference, they would either never come back to the office or only come back in once per week, which is a pretty significant change in terms of people's preferences around on workspace. And so lots to wrestle with in terms of the implications for companies and how they look at sort of the post-pandemic world. And so we'll be doing a lot more research and releasing a lot more of that in the months coming. From an overall unemployment duration perspective, you can also see from this chart The green bars are essentially the shortest length of unemployment. So green is basically less than 5 weeks, going all the way up to the black, which is 27 weeks and over. So when you look at these numbers, the short-term duration unemployment has gone down and is a lower percentage. And now you're starting to see a lot more in the 27 weeks and over. Sorry, that's the dark blue number on top of the graph. You're starting to see a much higher percentage of those in terms of longer term duration in terms of unemployment. You can see that a lot of people have crossed from that 15 to 26 weeks, the sort of lighter blue bar in the August, September, and it's kind of overtaking that by the darker bar, which is the 27 weeks and over. So we're seeing as the economy's challenges drag on that people are being unemployed for longer and longer periods. So again, some concerning information when you look at some of this. From a standpoint of job openings and self-employed, job openings we try to look at as one of the leading indicators of where we might start to see some recoveries, et cetera. And this information has just been really mixed as we look at that. We really, in April, we had a drop down to, basically 5 million or less in terms of job openings that were out there. And now we're starting to see it. Currently, it's hovering around 6.5 million job openings that are out there, but well below where we've been traditionally. And we're seeing it kind of hanging out at that level, that 6 to 6.5 million job openings. So not seeing a lot of increase, not seeing a trending towards where we would have been back in December 2019 or even the previous years. So that's concerning as well. When you look at self-employment and some of the trends that are there, you can see that's stayed somewhat steady until recently, where you're starting to see, where an overall decrease. Right now, we're at about 8.5 million in terms of self-employed folks out there in the marketplace. It's about 3% lower than it was a year ago, but overall, that's held fairly steady. One of the big question marks that is there from a policy perspective is what will happen with the unemployment support for self-employed folks over the long term, and will that continue to be in place, or will we go back to sort of some of the old policies around that? Some impacts on households, some things to think about when you look at this, because there's real people behind these big numbers, and so we try to look at it from a standpoint of what are the actual implications for people and how it's impacting their lives. So the U.S. Census Bureau does a household pulse survey, and this one is from the week of December 21st, so right before Christmas. But they ask things such as loss of income and food shortage and things like that. Some of the interesting numbers are, 31% of the adults at that time expect someone in their household to have an income loss in the 4 weeks coming. That number is higher than it's ever been, and has stayed at that kind of 29 to 30% level for a while now. 9.5% of the people surveyed say that they're not current on their rent or mortgage, or have little or no confidence in their ability to make the next month's payment. This number has bounced back and forth, and some of it is correlated to different states, for example, who have moratoriums on foreclosures and things of that nature. And so it'll be interesting to see where this number goes. The Biden administration has taken some action in terms of foreclosure forbearance and things of that nature, and so we'll have to see where some of these numbers go. 13.7% of adults in households had food scarcity in the last 7 days, and this is a really important number from my perspective. 37.5% of the adults surveyed are in a household that is having difficulty paying for usual household expenses. So that's not, your luxury expenses or things like that. That's sort of the normal bills and things that people are used to paying or have to pay. And so that number has continued to increase, and we continue to look at that as a problematic number, and something that's going to be a continued challenge. These vary quite a bit in terms of states and where some of the impacts are. For example, when the two highest states with food scarcity are Louisiana and Mississippi, who are having a lot of challenges in terms of the in terms of their overall economies. the southern border from California to Mississippi has really had some challenges in terms of difficulty paying for usual household expenses. So that whole southern belt, across there from the West Coast to the Mississippi is all challenging there. The rates, even when you look at the first number, the loss of income number, the lowest number was about 18% in Utah, but the number was very high, 42% in California, in terms of people who are expecting to, lose their income or lose their source of income. So a lot of challenges. It's when you look at even the housing numbers, you've got 8 states where that number is over 12%, and in Louisiana it's as high as 18%. So these can vary quite a bit by the state, and it can vary by the overall strength of their economy, some of the actions that their government has taken, et cetera. But important numbers to look at in terms of the real impacts on people. So when you look at some of other numbers which are important to note, one you'll see is this sort of 5.1 annual percent change in hourly earnings, which may sound like a good thing, that people's earnings have gone up. But the real story behind this number is that the low wage jobs have really been the ones who have been disproportionately hit. And so the impact on, overall wages is that it seems like people are earning more, but the truth is that there's just a lot less people with the lower paying jobs, and so it raises the average overall. So definitely not necessarily a number to celebrate in terms of the overall percentage of increases. 2.4% right now is the annual percent change in employment costs index. So this looks more at what employers pay for employees, probably a little bit bigger of an indicator in terms of how wages are changing through the course of the pandemic. The consumer confidence index is down at about 88.6%. This has been much higher in previous years, and it's actually declined a little bit in terms of recent months. We've had it up above 90 at points, and now we're back below 90. Overall consumer price index, 0.4% consumer price increase when you look at December, and we're estimating about a 1.4% annual increase in terms of the overall consumer price indexes. Many companies have had to put price increases in place based on increases in raw goods, transportation costs, things of that nature, and so that is flowing through to consumer prices and impacting consumer prices in terms of where those go. Looking at some of the leading indicators, we're seeing a continued decrease in commercial construction spending, which is usually one of the things that is an indicator of sort of the economy starting to pull up. There's multiple factors in play here. Some of it is the overall economic situation, interest rates, things of that nature. But part of it too is a number of softening points that we're seeing in the commercial real estate market, and a question mark about where the overall commercial real estate market is going to go. So you're seeing a lot less focus on building and things of that nature. You are seeing vacancy rates starting to tick up in certain cities. And you're seeing a lot of sort of major announcements of companies consolidating real estate and things of that nature, which really reflects sort of a change in strategy about real estate and facilities post-pandemic. And we anticipate that this one is going to be a key thing to watch and have significant implications over time in terms of where the economy is heading, but also how that whole commercial real estate sector and what it's going to look like. If you look at the overall sort of decline in single family households sold. You saw a sort of peak in the later part of the third quarter, earlier part of the fourth quarter. You're starting to see a pullback both in terms of the loosening of requirements for loans. Those are getting tighter, as well as increases in mortgage rates. And so all of those are starting to impact the overall housing picture and what that looks like. And so we're seeing a decline from the summer that is, larger than we would typically see. Another leading indicator is around durable goods orders. We're seeing some slow improvement in that respect. You can see that we're, well off the highs that we, or I should say the lows that we were at, but we're not back to where we were in previous years. And so continues to be a concern, continues to be an area that we watch. So when we look at all of the leading indicators, there's nothing that really says to us right now that we're looking at a strong rebound or, any sort of short-term sort of improvements that we think would be significant. And so we do have some concern about the short-term velocity from an economy perspective and where that might head. As I mentioned earlier in the webcast, all of this is of course premised on we don't know what actions the government might take in terms of trying to stimulate the economy or what those things might look like. And so that is certainly a big uncertainty point, but left to its own devices, it looks like we're still into a slog and some slow recovery from an overall economic perspective. So what should companies be doing or what should they be thinking about right now? It's tricky right now to look at things from a talent perspective because when you look at where companies are, they're still overall hesitant to make too much in the way of investments or extend themselves too much. A lot of uncertainty about what their overall economic outlook, revenue outlook will be, and a lot of factors that people are looking at to say we just don't know what's going to happen. So it's important for organizations to take proactive steps to be cautious about how they're doing it. So the first step is really to look at your talent and try to understand where your risks and opportunities are. And some of that goes into, how are we sort of managing the talent that we have today? A lot of organizations have been almost in a holding pattern in terms of thinking about their work environment, the kinds of processes and policies they want to have in place, what they're going to look like long term. And that's understandable given the uncertainty that we've had in the economy, in COVID protocols, all of those kinds of things. But as we're starting to see in more and more organizations where the number of quits are starting to increase, the number of people who are voluntarily leaving the workforce are increasing. That strategy can be dangerous. People don't really like uncertainty. They don't like a vacuum. They don't like not sort of knowing what's going to happen. And so it's important for organizations to really start to take a look at what their process and policies are going to be, what their work environment is going to look like, and how that's going to work going forward. Are you going to change, are you going to change your talent management protocols? Are you going to change the way that you manage things in the course of how your relationship with your employees? So that's really an important consideration to look at as you start to look at your talent. Try to understand where there's risk of loss, try to see where there's opportunities to either upgrade talent or take talent from other places, et cetera. A second concern and a second area to look at is knowledge loss risk. One of the things that we've seen from organizations, and one of the big concerns that we've heard from a number of organizations, is as they've lost employees, either because of people leaving, because of people being laid off, or in some cases, unfortunately, because of health concerns, many times they've lost critical knowledge or that they didn't necessarily know where it resided, and it's impacted their operations. It's impacted key customer relationships, it's impacted processes or manufacturing streams or things of that nature. And so taking a critical look at where knowledge loss is a potential risk, where you have dependencies on small groups of people, or in some cases one individual, is really important, because a number of organizations that we've worked with have really gotten bitten by this in terms of sudden loss of knowledge that's impacted their operations. When we look at it, there's 3 R's. There's actually 4, but the 4 I'll sort of talk about in more detail in a second. But restructuring, reskilling, and reshoring. When you look at operations overall, it's a good time for organizations to be thinking about what their future structure is going to look like. What kinds of organization structure do you need to have? Do you need to have a more centralized, a more consolidated organization structure? Certainly one that's more agile, more nimble, that can sort of adjust on the fly. It's a good time to take a look at those kinds of things, where you locate people, where those operations are. All of those are really important considerations right now. And so now's a good time to really think about what should our structure look like and how should we operate as an organization. At the same time, it's important to think about the skills that the organization really needs to to move into the future. There's a couple of different categories of that. Certainly from a standpoint of leaders and managers and the skills they need to be effective in managing in today's environment, more in the way of virtual collaboration, more in the way of managing accountability remotely, more in the way of sort of driving performance and engagement and culture and things of that nature. Managers and leaders, there's a lot of skills that they could use in terms of improving their ability to operate in the workplace as it stands today. Another area is really technology skills. In terms of people using collaboration tools, using knowledge management, things of that nature, there's been a lot of, we've certainly all been forced to get better at using collaboration tools and tools like Zoom and webinars and things like that. But in many cases, we're starting to see, web fatigue and things like that. And a lot of it was rolled out more by necessity instead of being planful. We really need to kind of rethink and reset in terms of the skills associated with managing virtual collaboration and those tools, et cetera, and think about what are their place are going to be, what's the appropriate use of them, how's that going to work. And then finally, from a skills perspective, thinking about what are new skills that people are going to need to really be effective in the post-pandemic world, and starting to make investments in those skills now. Reshoring is another area in terms of looking at operations, and I mentioned briefly looking at locations of operations, but that also extends to looking at your suppliers, looking at your supply base, where you get things made, where you get supplies from, things of that nature, and thinking about, given the kinds of disruptions that we've seen through the course of the pandemic in transportation and manufacturing, et cetera, what are the implications for that, and how should you think differently about your supply chain? We were working with a client recently who got a lot of things from Australia, and Australia has gone through a series of lockdowns and release of those lockdowns, et cetera. And so in many cases they would go for weeks where they wouldn't be able to get supply from some of their key suppliers in Australia. So those are the kinds of things that people expect delays or disruptions, but not to the level that they've seen this year. So really thinking about your operations as a system and what that looks like it's important to do that and understand how you create, as resilient of a supply chain as you can. The fourth R that I mentioned is really relationships, and looking at the relationships between companies and their employees and what that looks like. And now is really the perfect time to rethink those relationships. And that comes down in a number of different places. One, understanding your employment brand and your employee experience and what you want that to look like. While I don't know, the right answer for every company, I can say that for almost every company, it's going to be different than it was a year ago, right? And really rethinking what that employment brand is all about, what that experience is going to be, and what the relationship between employees and employers are going to be. Just a brief plug for a webinar that we have coming up here shortly, where we're really going to dive deep into this area of employment brand and employment experience, employment relationship, and looking at how to redefine that for the future. Because frankly, the expectations of employees in terms of what they want from their employer, what they expect from their employer, are changing. And we're starting to see that in data. We're starting to see that in, employee behavior. So there's a number of things to be rethought. What will our future workplaces look like? And that answer is going to be different company to company, industry to industry. So taking the time to sit back and strategically rethink that and rethink your brand and reset the expectations from an employee perspective is absolutely critical to avoid, losing talent, to help maintain engagement in the workplace, things of that nature. It's all going to be really important to rethink those. Related to that is the emphasis on employee health and employee mental health. Some of the data that you'll see out there shows, significant increases in many cases in mental health issues in the workplace, incidents of people experiencing mental health issues, overall health problems, not just from COVID, but from other, kinds of things we're starting to see. For example, delays in cancer screenings that were happening early on in the pandemic now resulting in higher incidences of later stage cancers that are being discovered. And so the health effects, not just COVID itself, but all the things around it, are just now really starting to be understood. And the implications for employers is significant. Many people still, their primary source of benefits is from their employer, and so there's a huge link there. And again, as I mentioned earlier, the expectations of employees about the role that employers are going to play in some of these things are changing. And you need to look at your workforce and understand what those expectations are. But no place is that more the case than in the area of mental health. And really the expectation that employers are providing more in terms of mental health resources. The answer for mental health in many organizations for many years has been, oh, well, we have an EAP program. But there's a lot more to it than that. And we really need to think about, for example, what skills have we built in our managers to really understand the whole person as they come to work and what they might be dealing with from a mental health perspective. Any issues at home in terms of the physical health of others or mental health of others or things of that nature. These are things that we tend to not want to talk about. We not want to deal with in terms of the overall, in the workplace, and we try to keep those as sort of quote unquote after hours kinds of issues. But it's going to become increasingly more important both to have the resources available as well as to have the managers and leaders in our organization better able to deal with those things. Again, the webinar that we have coming up in early February is going to dive even deeper into that particular area. Lastly, looking at changing work processes and in many cases trying to increase automation, really looking at where there are opportunities to reduce the reliance on in-person work and in-person interaction in order to be able to deal with the kinds of things that we deal with today. Looking at the work process and trying to find ways to make those more automated, make those more streamlined is going to be more important. Ideally, that leads to the ability of workers to focus on higher end, more value added work, but it is important to really take a critical look at work processes overall, where people are from that standpoint, and look at where strategic investments in automation make sense and where work processes should be changed. Now, as I said in the beginning of all of this, it's important to be looking at these. It's important to be trying to redefine what you want your workforce and what you want your work environment to be, recognizing that many companies are going to be cautious about making investments. So it's really important to have the analytics behind all of this to really understand what the implications are, what the potential cost impacts are, what the likelihood of success are, et cetera. And so that requires a level of analytical skill that some organizations don't have, frankly, but it's really important to kind of run those numbers and really see any investments that you're going to make, what are the impacts of those actually going to be, and get that in more concrete terms. But it's important to step back, really rethink about the work environment, the working relationships, employment brand, things of that nature, and be very planful and be very thoughtful about what you want those to be going forward. We know there's going to be a lot of uncertainty in the marketplace, but we know that things aren't going to be able to sort of just go back to the way that they were, both because of where we are from an overall public health and economy perspective, but also because of the preferences of employees and what they're going to be looking for out of the workplace. So that concludes what I had to present today. So sorry I don't have lots of better news for you in terms of where we are with some of these things, but I think it's important for everybody to get a picture of just the level of uncertainty and the level of back and forth that we're seeing in the economy, and to be able to plan and act accordingly. So with that, I will open it up for questions.
Thanks, Brian. I was thinking as we reviewed your presentation, I agree, still tough news to deliver, but I do feel like it's a little bit better than second quarter, slightly better than third quarter. So we're making progress, right? In some areas.
Yep, definitely.
Yeah, so I have a two-part question for you here, and I know in your time dealing with clients, employers struggling with decision making, the time of uncertainty and the outlook on the economy. And so the first part of the question is for employers that are really struggling with, how do we make decisions around all this uncertainty? What's your advice? And then to carry that forward, how what's the suggestions on how you communicate that to employees? So where's the economy heading? Employees are feeling uncomfortable in such a time of uncertainty. So to start with the employer decision making process and your advice there.
Sure. Well, one of the big things that I would say is that data is more important than it's ever been. And it's really important to get specific data. So I mentioned in a number of places, here's the overall trend, but here's the very significant differences that you see sometimes by state or by industry or things of that nature. And so it's important for companies to be data driven, but that data really has to be specific to their situation and to their industry, et cetera. So companies should be trying to create a good predictive analytics capability that takes that data and can really process it and give it to decision makers in a way that they can actually do useful things with it. So decision makers have to be able to have, as much certainty, as much clarity as possible. So it's important to really have that analytical foundation that's specific to your world. At the same time, one of the interesting things that we saw during the pandemic is that many organizations were forced to make decisions much more quickly than they would have otherwise. So for example, mandates came into place in terms of how people have to change their operations, et cetera. They didn't have, 6-month long committees and things like that to figure out how to do it. They got teams together, very quickly figured out what the processes and procedures were going to be and put them in place, right? And in some cases, those worked very well. Other times there were things that need to be tweaked, but they were able to tweak those very quickly and move. And so there's a lesson there in terms of corporations around decision making, in that perhaps we tend to overcomplicate decision making, and we tend to think a little bit too much and drive a little too much process around decision making in organizations. And can we find out what worked in terms of our early decision making that was maybe forced to be quicker, et cetera, and apply that to decision making going forward? So I think that there's, we kind of have to look at the specific situation that the companies are in, to try to find out what the right approaches to things are. But at the same time, I think companies can move quicker than they think they can in terms of making decisions. If you don't have the data, if you don't have the ways or the things that you regularly look at to really know what's going on, that's definitely a first step. Get that sort of set of decision analytics that is going to drive your decisions and help you really understand what makes a difference. And especially getting those predictive ones in place is absolutely critical. In terms of the second part of the question and communication, transparency is key. I think that one of the things that we've heard anecdotally from a number of clients where they've started to experience retention problems and people leaving voluntarily, et cetera, I think many of them lament the lack of transparency that they've had with some of their decision making, some of their processes, some of their communication throughout the course of the pandemic, and feel like that's really impacted, their organization and people's intent to stay with the organization or engagement in the organization. Sometimes that's about decision making overall, but sometimes, frankly, that's been about whether or not the organization has taken stands on critical issues that have come up in the world, whether they be social justice issues or whatever that might be. And we are seeing, especially in the younger generations, increasing behavior where people are making decisions based on how companies have reacted, not only to their employees specifically, but certain issues out in the marketplace. So lots there, but I mean, that would be some of my key advice in terms of decision making.
Great, good advice there. I'll mention, Brian, we've got a number of questions, so just want to make sure that our attendees know if we don't get to your questions, we do try to reach back out to you through our employees and try to answer your questions and get you more information. So I know I laugh because I always get these. People want you to do a lot of predictions in these, and so webinars. And so we've had some questions around, give us your characterization of the overall outlook for the economy in the short term. You talked a lot about that in reviewing the leading indicators, but looking for some more information there on your thoughts.
Unfortunately, this is being recorded, so if I'm wrong, we can check later. But when I look at it, I think we're still, honestly, 6 to 9 months before we're going to start to see sustained recovery.
Mm,
I think that what we're seeing right now is that there's enough uncertainty, there's enough going on that companies are going to be very cautious about investments. I think that consumers are going to be cautious about spending. I think you could see some short-term bubbles based on what kinds of stimulus packages go out there and that sort of thing. But in terms of sustained recovery, I think we're still 6 to 9 months before we start to see the numbers trending sustainably in the right direction. Um, that said, I think that that creates opportunities for certain organizations depending on where you are financially. So a number of companies, for example, have been very conservative in their management through the pandemic and find themselves in, relative positions of strength from a cash or other kinds of perspectives. And so it's a great opportunity to be looking at, are there strategic investments or acquisitions or things like that you can make, but at the same time being cautious about those investments and being very judicious about those investments. But unfortunately, I still think you're 6 to 9 months out of sort of a sustained recovery mode. I think you'll see
mm.
some uneven bursts here and there in different industries, different sectors, based on different demand and where that goes. But I'm cautious overall in terms of the economy.
All right, and you're right. This is being recorded, so we'll be able to go
This
back
is
and see how your prediction came about, right?
yeah.
So you struck a chord talking about talent. We always get a lot of questions around talent in these webinars, and talk a little bit about what we're seeing as top skills that are in demand for leaders and employees in this new environment.
Leaders is an easy one. They're really looking for people who can operate in uncertainty and operate successfully in uncertainty. They really are looking for people who can integrate a lot of information and make good decisions from it, and move forward in confident manners. I think that what a lot of organizations are experiencing is a lot of paralysis, a lot of indecision, a lot of concern about, well, what should we do, and then not doing anything because of it. So organizations are really looking for leaders who can cut through that, who can cut through that ambiguity and cut through that uncertainty. They're also looking for leaders who can engage talent in this world. Really leaders that have empathy, leaders who are authentic, who are genuine, who, even when their interactions are virtual with employees, they're still impactful because they're
Mm,
authentic, because they communicate well, etc. And we've even seen, frankly, some investment groups and high level stakeholders do significant changes at the leadership level because they didn't have that, and they were seeing the impact on the organization and felt like they had to take action in terms of putting different leadership in place. So at the leadership level, those are some of the really key components that we're seeing in high demand and high emphasis. From an employee level, I'll mention sales for a minute because this is always one that's interesting during a downturn, right? It's much harder to sell in an economy like this than it is in an economy that's doing very well and booming. And so a lot of people, as always happens when there's economic downturns, are quote unquote rationalizing their sales force and really thinking about what they've got and that sort of thing. I don't know why we don't take that lesson and apply it when times are good, but hopefully one day we'll get that right as well. But people are really critically looking at salespeople. They're really looking at relationships. They're really looking at the ability to sell in these times. The demand for technology skills has been interesting. Initially we saw a lot around collaboration technologies and, app development and those kinds of things, and some of that has started to weaken. But what we are seeing is employees who are comfortable with using technology and nimble at using technology is in high demand, and that's something that organizations definitely want as they're looking at. So in many cases, it's sort of not, I won't call them soft skills, but they're sort of more generalized skills that are in demand as organizations are recognizing some of the weaknesses that they have. So they're less willing to accept people who aren't comfortable with technology as it stands now. So those are some of the overall trends that we're seeing. Other things from an employee skills perspective come down to more industry and what they're specifically looking for there.
Yeah, going a little bit further, we had a very specific question around how automation is affecting the ability of people that are in lower paying jobs, lower skilled jobs to come back into the workforce. And I know we have a number of clients that are really refocusing on retraining. Can you talk a little bit more about what you're seeing companies do that may be spending more money and focus on automation, but want to keep those employees in the workforce if possible?
Yeah, it's an excellent question. I'm glad someone asked that, because this is an area that we see a lot of interesting information and some concerns about. So as companies, they are really significantly focusing on automation and finding as many ways to automate as possible. And frankly, the new administration coming in has just accelerated that in a lot of ways, as minimum wage mandates and things like that start to creep over the horizon. And so we're seeing a lot of organizations, for lots of reasons, focus heavily on automating jobs, and a lot of those are the lower paying jobs. I would say that, unfortunately, though, it's a smaller percentage who are really focusing on retraining their workers and trying to find ways to retain them. And I'll tell you kind of how that breaks out. When I look at some of the, manufacturing technology, things where there are, skills that are going to continue to be in high demand, even though they may not be the skills that the workers have today, those organizations are tending to invest in reskilling, retraining, those kinds of things. They're looking at it as, these employees know how to operate in our culture, and they've proven that they're good workers and they have a good work ethic and fit from a culture perspective, et cetera. And so we want to make the investment in reskilling them and training them at a higher level. And I don't want to say it's exclusively those industries, because we are seeing it in some of the higher end distribution, organic food production, some different things like that. We're seeing it in those areas as well. But I think what we're seeing in a lot of more generalized skills, distribution, some of those pieces is they're not reinvesting, and they're just really letting those workers go back out into the workforce to try to fend for themselves. And so, and we don't, in the United States, we've never had the level of support for reskilling, retraining that we've needed to had to sort of handle big shifts in technology or things like that. And so when you look at the workforce and you look at the difference between the total unemployment number and the U6 unemployment number, they're significant. And there's definitely a percentage of those workers who the challenge is their skills, and they really need to be reskilled and have that additional training and education and investment. And we don't have the public infrastructure to do that as it stands now. So that's going to be a big challenge for the next year, is that class of displaced workers that needs that reskilling and re-education that is not being provided by their employers. So I see that as, while there's some good news in terms of certain sectors are making that investment, there's a number of others who aren't.
I have a feeling there'll be more to come in our upcoming webinars around the reskilling and retraining. So,
yeah.
All right. So you mentioned it. You opened the door for me to ask the question. You said new administration. I know I'm looking forward to April. I don't know how you're going to fit it all into an hour for first quarter. We'll come back again. But give us some of the implications you think the new administration is going to have on the economy, particularly in the short term.
Well, I think that it will be much more active in terms of regulation and changes in workplace regulations, employee-oriented rules and legislation and those kinds of things. So I think from an employer perspective, be prepared for a lot coming your way in terms of those things. So I think that organizations are going to have a concentrated effort on keeping track of what's coming in terms of rules and legislation and things of that nature, and be ready to react to it. And I think that 6 months from now, we're gonna have a lot to talk about in terms of changes in that respect. I think we're starting starting to see just from the large number of executive orders that have come out, where some of those leanings are, but also looking at some of the cabinet appointments and knowing what some of their issues are, or sort of causes that they want to support. I think there's going to be a lot in terms of actions that impact employers. From an economy perspective, I think that we will see some level of consumer stimulus, but my concern is that that's only going to give us a short-term bump in terms of spending, et cetera. And unless we can get to a place where, jobs come back and we start to see, a much lower unemployment rate, et cetera, we're going to continue to see overall weakness, even though we might see some short spurts of that. So, from my perspective, what I hope we see is a focus on more sustainable economy building, right? It's important to directly stimulate the economy, and I agree with that. But at the same time, if we're not doing things like investing in reskilling and investing in job creation and things like that, then we're going to be sluggish, and we're going to be in this sort of low growth, no growth kind of mode for quite some time. And so we'll see. I can't predict sort of how much emphasis is going to be on that. The emphasis right now seems to be a lot more on stimulating individuals, which is important but not enough. So that's really my concern when I look at some of the things that we're seeing.
Yeah, thanks for that, Brian. And actually, we just did a webinar yesterday with our general counsel, Amy Remington, talking about the election results and particularly focusing on employment law. So that webinar is available on demand on our landermhr.com website. So we do have some upcoming events that Brian mentioned. On February the 3rd, we'll be talking about charting a new course for employee behavioral health and wellness. On the 4th, for a quick follow-up there, navigating 2021 employment challenges. Those events are on our hrqinc.com website, and love for you to register for those. Brian, appreciate the team. I know this is takes a lot of work to put this together with your entire team, and once again, just great content. So please answer our survey as you exit today and give us more feedback. And on behalf of Landrum HR and HRQ, thanks for joining us.